So here we go again, my efforts to make a nice short video for you guys. This is going to be the first video to deal with the A2 monetary policy. I'm going to look primarily here at the instruments and the objectives. When I say instruments of monetary policy, what I basically mean there is what tools are available to the central bank to implement monetary policy, and objectives are the primary goals that they may have for their monetary policy. So down the left hand side there, the four in blue, these are the main instruments that that we need to be aware of. Interest rates was primarily covered AS, so we're not going to spend too long looking at that. Control of money supply is a really important one at the moment, because that's where the idea of quantitative easing is considered, and a couple of others that they have to control what's called the monetary base are the reserve asset ratio and the capital requirement. I'm going to go through each of those in a little bit more detail, but then we'll move on to the objectives. The key kind of monetary policy objectives, generally, it's either to deal with inflation or it's to maintain the value of the currency. So I thought the best way to consider this would be to consider how these things have evolved in the UK in the last 40 years or so. So what I want us to do is think about the monetary policy in the UK, and we're going to kind of start in the 1970s, which is when the monetarist school of thought really started developing. So monetary policy has really been a key area of macroeconomic policy since then, and we're going to try and bring it right up to the present day. So above the red line, if we kind of see over here, so above the red line we have the key instrument that was being used in that period, and under the line we have the key objective of monetary policy during that period. So just trying to summarise really what was going on and the main thinking that was taking place. So between 1970 and 1985, this is when the monetarist school of thought was very much dominant in the UK and also in America. The key instrument, according to classical monetarist theorists, is control of the money supply. So the main way that they tried to influence the level of inflation, which was the key objective, was to try and control the level of money supply within the economy. And it met with a number of difficulties, primarily because they found it very difficult, believe it or not, to define what they actually meant by money. And this will be in a later video, but there are a number of ways you can consider different assets and the extent to which they are money. And there was a lot of disagreement amongst monetary policy proponents and between monetarists about exactly what should be controlled in the form of the money supply and how it should be controlled. So the target, the objective was the control of inflation, and the key instrument that was being used was control of the money supply. And that continued up until 1985. In 1985, control of the money supply was abolished in large part, mainly because of these disagreements that I was talking about. They couldn't actually decide what form of money supply they were actually going to control. So at that point, the key instrument became interest rates, and the Bank of England in the UK started to use the interest rates. Now, the key objective that they had during this period, 1985 to 1992, was actually currency valuation. And the reason for this was that this was the point in time where Britain was involved in something called the exchange rate mechanism, which is often abbreviated to the ERM. And this was the plan, the mechanism that was put in place in order to try and align the various currencies in Europe. It was a precursor to the single currency, which obviously has gone ahead and is now the euro. But back in 1985, there was a process of currency alignment that took place. We'll look at why they would have done that a little bit later on in the course when we consider single currencies. But basically, the key aspect of monetary policy at this point was for the government and for the Bank of England to try and maintain the value that had been chosen within the exchange rate mechanism. And that continued, as we can see there, for 7 years. until 1992, when it became increasingly apparent that Britain couldn't maintain its currency at the value that it had set. Basically, it had set the value of its currency far too high, and it was the interest rates going up and up and up and up were trying to support the value of the currency, but they were also causing a real pinch on the levels of aggregate demand in the economy. This all came to a head in 1992 on what's called Black Wednesday, when Britain pulled out of the exchange rate mechanism, and the currency fell very, very quickly, and we entered a short recession. So from 1992 to 1997, the key instrument remained interest rates, but the key objective returned to the control of inflation. And again, that remained the same up until 1997. And in 1997, nothing actually directly changed. The key instrument remained interest rates, and the key objective was still inflation. The difference was that in 1997, what happened was that the Bank of England was made independent. So up until that point, it had been part of the government, part of the Treasury. In 1997, it was made independent. The idea was that it would make decisions purely on economic basis, not political basis. The difference in terms of the policy was that the Bank of England was given the target of maintaining inflation at plus or minus 1% around a target rate of inflation. To begin with, it was 3, more recently it's been 2, but basically at this point the Bank of England was told that they had to try and maintain inflation within this boundary. Importantly, this was the first time that it was really acknowledged that very low inflation could be equally damaging as high inflation. Up until this point, really, the goal of inflation management as the main objective was to just keep inflation low. Following on from 1997, particularly the problems that they'd had in Japan with deflation, it was actually realised that the inflation falling too low could be equally problematic. And that's why the Bank of England was set the target of a target rate of inflation plus or minus 1%. And that was the situation up until 2009, which mainly followed on from obviously what happened in September 2008, which was the onset of the financial crisis. The key instrument remained interest rates. So the key instrument was still interest rates, but we also had the introduction of QE, or quantitative easing, at this point in time. So efforts to actually increase the amount of money in circulation. What the central bank did was it basically bought illiquid assets from the high street banks and replaced them with cash. So the high street banks, which were holding assets which they couldn't lend out because they were illiquid, they gave those assets to the Bank of England. The Bank of England gave them cash in return, and the idea was that hopefully that would increase banks' willingness to lend. So over a period of time, it was £375 billion was put into the UK economy in that way. The key objective, again, remains inflation, officially, for the Bank of England, although more recently there has also been some discussion about whether they should also be able to target economic growth as being a primary objective. Officially it's not, but the fact that interest rates have been so low for so long, and the fact that they were also low during a period of relatively high inflation, suggests that the Bank of England is taking a wider stance with its monetary policy and actually also focusing on developing economic growth as well. And more recently, not so much for the point of view of monetary policy control, but the FSA, which is a branch of the Bank of England, has introduced capital requirements following on from an agreement in Switzerland in a place called Basel, which basically say that the banks have to hold capital of a certain standard, and enough capital to actually meet their requirements, basically so that they are not in danger of requiring further bailouts. So that's really kind of mapping out the evolution of different monetary policy methods which have taken place in the UK.